In 1996, high on Mount Everest, a team of climbers pushed toward the summit even as the weather began to shift. Clouds thickened, winds sharpened, and the guides urged retreat. But the climbers had invested weeks, even months, to get here. To turn back felt unbearable. They pressed on. Hours later, a storm swallowed them whole. Some never came down. That tragedy became known as one of the deadliest Everest expeditions in history, not because the climbers lacked skill or courage, but because they lacked what mountaineers call a turnaround time. A hard rule: if we haven't reached the summit by 2 p.m., we descend, no matter how close we are. It's not about the mountain. It's about survival. Traders face the same summit fever. The market lures them upward with the hope of profit, even when the conditions have turned deadly. Without a personal turnaround time, a rule to cut off not the trade, but the swelling emotion, they get caught in storms of their own making. This is the essence of an emotional stop-loss. The courage to turn back from the summit of temptation before the storm destroys you. Defining the emotional stop-loss. A stop-loss on a trading platform is simple. You set a line in the sand where the system cuts your trade automatically. But what happens when your mind refuses to respect that line? What happens when your finger hovers over the cancel button, whispering, "Just a little longer, it'll come back"? That's where an emotional stop-loss comes in. Think of it as a psychological turnaround time, like Everest climbers use. It's not about the market's movement, it's about your movement. The point at which your emotions have become too volatile to trust. It's the decision to cut yourself off from destructive impulses before they snowball. Here's the difference. A price stop-loss guards your capital. An emotional stop-loss guards your clarity. When you set an emotional stop-loss, you're not only deciding how much money you're willing to risk, you're deciding how much mental chaos you're willing to endure before you walk away. It's a recognition that mental capital is just as finite as financial capital. Most traders only measure risk in dollars. Professionals measure risk in psychological stamina. Because once your emotions are spent, you can't see the market clearly. You chase, you revenge trade, you throw good money after bad. An emotional stop-loss, then, is not a single action, it's a boundary. It's the mental checkpoint that says, if I feel X, if I think Y, if my behavior crosses Z, and I stop trading, no questions asked. This boundary transforms trading from a battlefield into a practice field. It allows you to recover before emotion takes you out of the game completely. And here's the irony. The traders who set emotional stop-losses end up surviving long enough to profit, not because they control the market, but because they control themselves. The trader who walked away. Paul Tudor Jones is now one of the most respected hedge fund managers alive. But early in his career, he nearly lost it all. One disastrous cotton trade left him spiraling. His losses weren't just financial. They bled into his confidence, his judgment, his entire sense of control. Jones realized something vital. He wasn't just losing money, he was losing himself. And if he didn't build a system to guard against that, his career would be over before it truly began. So he created a personal rule, one that every trader should memorize. Losers average losers. In other words, he swore he would never throw more money into a losing position, no matter how strong the temptation. That was his emotional stop-loss. It wasn't on the chart, it was in his mind. But Jones didn't stop there. He learned to physically walk away when emotions started taking over. If a trade cuts too deep, he closed the screen, left the office, and went for a run. His logic was simple. You cannot outthink a storm while you're still standing in it. What saved his career wasn't just technical skill. It was the ability to protect his mental capital with hard boundaries, rules that were emotional stop-losses in disguise. And this is the overlooked truth. The great traders of history didn't just manage risk with numbers, they managed it with self-control rituals. Their success was built as much on psychology as on strategy. When you look at traders who survived decades in the market's Jones, Ed Seykota, Ray Dalio, you see a common thread. They all developed inner mechanisms to stop emotional bleeding before it destroyed their judgment. That is what separates legends from casualties. The psychology behind the emotional spiral. Every trader believes they're rational until the screen lights up red. But neuroscience has proven something brutal. When money is at risk, the human brain does not behave like a calculator. It behaves like a survivor. The biology of a loss. When you take a trading loss, your body reacts with the same chemical storm it would if you were facing physical danger. Cortisol spikes in your bloodstream. Your amygdala, the part of the brain responsible for fear and survival, fires up. Your heart rate climbs, your breathing shallows, and your perception narrows. Loss aversion. Why pain hits twice as hard. Psychologists Daniel Kahneman and Amos Tversky discovered what traders have lived through for centuries. A loss hurts twice as much as a gain feels good. This is called loss aversion. It means that when you lose $500, you'll experience twice the emotional impact compared to the pleasure of gaining $500. And that imbalance drives destructive behavior. You hold losers too long because selling locks in the pain. You cut winners too quickly because you fear they'll slip away. You take impulsive trades just to erase the sting, even if the odds are terrible. Loss aversion is why the market often feels like quicksand. The more you struggle emotionally, the deeper you sink. The illusion of control. Add to this the illusion of control. Humans are wired to believe that with enough effort, they can bend outcomes in their favor. In trading, this becomes lethal. You start adjusting stop losses, adding to losing positions, moving targets. Each adjustment feels like control, but it's actually self-sabotage disguised as strategy. This is where the emotional stop loss becomes non-negotiable. It acts as a circuit breaker against your brain's survival wiring. Cortisol spikes? The rule tells you to step away until the storm fades. Loss aversion kicks in? The rule locks in the pain now, sparing you greater pain later. Illusion of control whispers, try again, fix it, push harder. The rule silences it by shutting down further action. You're not fighting your biology with willpower alone. You're outsmarting it with structure. Think of it like a seatbelt. You don't wear it because you expect to crash. You wear it because you know that in the chaos of a crash, you won't have time to decide wisely. An emotional stop loss is the seatbelt for your trading mind. And here's the sobering truth. The traders who refuse to build this safeguard are not beaten by the market. They are beaten by themselves. Their downfall is not bad strategy, it's unregulated emotion. We've seen how biology betrays us and how loss aversion warps our perception. But let's step further into the minds of traders who have studied this battle up close, and those who have fought and often lost it. Mark Douglas, The Paradox of Certainty. Mark Douglas, author of Trading in the Zone, became famous not because he invented new technical indicators, but because he exposed the psychological paradox of trading. The more a trader craves certainty, the more reckless they become. Douglas observed that traders who desperately need to know what will happen next fall into emotional chaos. Why? Because markets are inherently uncertain. Each trade is just one toss of the dice. When such traders face a loss, their minds revolt. They feel betrayed, almost insulted, as if the market should have rewarded their analysis. That anger or despair feeds into revenge trading, over-leverage, and impulsive decisions. Douglas taught that the only solution is to accept randomness at a deep emotional level. Only then can a trader act without fear or desperation. In other words, his whole philosophy was itself an emotional stop-loss, a mental line that prevents the trader from demanding certainty where none exists. Tom Howgard, The Best Loser Wins. Tom Howgard in Best Loser Wins takes this further. His philosophy sounds brutal. Success comes from learning how to lose gracefully, consistently, without flinching. Howgard confesses his own battles with emotion, averaging down on losers, blowing up accounts, falling into despair. What turned him around wasn't just refining his entries or exits, it was redefining his relationship with pain. He argues that the best traders are not the best winners, they are the best losers. They take losses like boxers take punches, expected, absorbed, and quickly reset. That's an emotional stop-loss in raw form. Instead of letting one punch shatter his confidence, the boxer keeps his composure, adjusts, and continues the fight. Howgard's success is proof that you can't trade by eliminating pain. You trade by containing it, by setting mental boundaries that prevent the sting from escalating into a spiral. Jesse Livermore, Genius Without Guardrails. Jesse Livermore, often called the boy plunger, made and lost fortunes multiple times in the early 20th century. His brilliance in reading the tape was unmatched. But despite his talent, his career was a roller coaster of spectacular highs and devastating lows. Why? Because Livermore had no emotional stop-loss. When emotions ran hot, he was powerless against them. He would press too hard, risk too much, and ignore the internal voice warning him to stop. His story proves a harsh reality. Skill without emotional guardrails is a recipe for destruction. Knowledge alone doesn't save you. In fact, the more skilled you are, the more dangerous you become if your emotions go unchecked, because your confidence fuels your recklessness. Ray Dalio, Pain plus reflection equals progress. Ray Dalio, founder of Bridgewater, built one of the most successful hedge funds in history. His secret wasn't avoiding mistakes, it was processing them with brutal honesty. Dalio has a simple formula. Pain plus reflection equals progress. Every mistake is an opportunity to learn, but only if you can confront it without emotional denial. This is where an emotional stop-loss fits perfectly. It creates the breathing space to reflect, rather than react. Without that pause, pain turns into panic. With it, pain turns into wisdom. The science of repetition. Taken together, these stories reveal a pattern. The great survivors of trading didn't avoid loss, they redefined their relationship with it. Douglas taught acceptance of uncertainty. Howgard taught resilience in losing. Dalio taught reflection on pain. Livermore showed the cost of lacking all three. Each in their own way embodies the core truth. An emotional stop-loss is not a trick or a hack. It is the evolution of a trader's mind, from fragile to resilient, from reactive to disciplined. Why this matters for you. When you sit at your desk and place a trade, you're not just battling the market, you're stepping into a psychological gauntlet. Without an emotional stop-loss, you're like a climber without a turnaround time, a boxer without defense, a pilot without a checklist. The question is not if your emotions will overwhelm you, it's when. And when that moment comes, do you have a rule that saves you from yourself? Building the mechanics of an emotional stop-loss. So how do you actually create an emotional stop-loss? It's one thing to admire Paul Tudor Jones for walking away from his screen, or to nod at the Everest climber's turnaround time. It's another thing entirely to design that safeguard for yourself. The process begins with brutal honesty. Most traders are eager to study candlestick patterns, moving averages, Fibonacci retracements, but ask them to study their own emotional triggers, and they fall silent. They know how the S&P 500 moves, but they have no idea how they move when under stress. Step 1. Identify your emotional trigger points. An emotional stop-loss cannot exist in theory. It must be anchored to your personal signals of instability. For example, do you start checking your phone compulsively when a trade moves against you? Do you feel your heartbeat climb, your jaw tighten, your posture change? Do you start narrating hope? It'll come back? It always comes back? Or do you start increasing position size after a loss, trying to win it back? These are not random habits, they're alarms. Each one is your psyche telling you, danger ahead. An emotional stop-loss is built by turning those alarms into rules of disengagement. Step 2. Define your emotional turnaround times. Just like Everest climbers set a 2 p.m. turnaround, you need predefined boundaries. Examples. If I lose more than 3% of my account in a single day, I stop trading for 24 hours. If I feel the urge to double down on a losing position, I close everything and step away. If I've taken 3 consecutive losses, I pause for the day, no exceptions. Notice that none of these rules are about price action alone. They are about emotional thresholds, the psychological equivalence of too far. Step 3. Ritualize the stop-loss. Rules only work if they're automatic. If you leave them in the abstract, your emotions will debate them in the heat of the moment, and emotions always win. You need rituals. 1. Journaling ritual. Write down after every session. What did I feel when I won? What did I feel when I lost? Did I follow my stop rules? By capturing emotions on paper, you turn fog into structure. 2. Physical ritual. When a rule is triggered, have a physical action ready. Paul Tudor Jones left his office. Another trader might shut down the trading platform entirely, or go outside for a walk. The physical break anchors the rule in the body. 3. Recovery ritual. Replace destructive impulses with constructive ones. For example, after hitting your emotional stop, commit to 30 minutes of reviewing your trade journal or meditating instead of doom-scrolling charts. Step 4. Create a visible reminder. Pilots use checklists. Athletes tape mantras to their lockers. You need the same. Write your emotional stop rules on a card, pin them beside your monitor, or put them on the login screen of your platform. When emotions surge, that reminder will catch your eye before your impulses hijack your hands. Step 5. Accept that it feels awful. Here's the harsh reality. Using an emotional stop-loss never feels good in the moment. It feels like retreat, like quitting, like wasting an opportunity. Just like climbers feel when they descend only meters from the summit. But survival in trading, as in mountaineering, depends on accepting that the goal is not this trade, the goal is the next 1,000 trades. If you burn out your capital or your mental stability today, you won't be around for tomorrow. The Emotional Stop-Loss Toolkit. We've seen the mountaineer's turnaround time, Paul Tudor Jones' walkaway ritual, Mark Douglas' acceptance of randomness, Howgard's art of losing, and Dalio's formula reflection. But again, admiration without action is useless. To build your own emotional stop-loss, you need a system concrete mechanics you can practice every day until it becomes part of you. Think of this act as your trader's toolkit. Each tool is a piece of armor, and together they form the protective shield that guards your mental capital. 1. The emotional trigger log. You cannot stop what you cannot see. Your first tool is awareness. How it works. Keep a log beside your trading station. Each time you feel a surge of emotion, anger, greed, fear, hope, write it down with time and context. Example entry, 10:32 a.m., Euro USD long stopped out. Felt urge to re-enter immediately. Heart rate increased. Thoughts, it'll turn back. Over time, you'll start noticing patterns. Maybe mornings bring more tilt. Maybe you spiral after 2 losses in a row. These are your emotional trigger points, the exact conditions where your stop-loss needs to activate. 2. Pre-market emotional checklist. Pilots don't fly without a pre-flight check. You shouldn't trade without an emotional pre-check. Questions to ask before entering the market. Did I sleep at least 6 to 7 hours? Am I distracted by stress outside trading, family, finances, health? Do I feel excitement, fear, or pressure before placing my first trade? Have I defined both my monetary and emotional stop-loss levels for today? If too many red flags appear, don't trade. Sometimes the strongest trade is no trade. 3. The daily drawdown rule. This is your monetary emotional hybrid rule. Example: if I lose 2% of my account in one day, I stop trading. Why it works. Financial drawdown directly correlates with emotional volatility. By cutting the day early, you prevent a spiral. But add an emotional layer. If I feel desperate to win it back, regardless of P&L, I also stop trading. That way, even if the drawdown hasn't hit yet, your emotions can still trigger the circuit breaker. 4. The 3-strike rule. Borrowed from professional poker players who use it to avoid tilt. If you take 3 consecutive losing trades, no matter how small, close your platform. Don't interpret. Don't argue. Don't bargain. Just stop. This prevents what Tom Howgard warns against: the spiral of trying to make back losses by force. 5. The recovery ritual. Closing your laptop isn't enough. You need an active ritual to reset. Physical reset. Exercise, stretching, or a short walk. Movement burns off cortisol and resets physiology. Cognitive reset. Write in your journal what you felt, what rule triggered, and what you'll do next time. Time reset. Commit to a fixed cooldown. 30 minutes, 1 hour, even the rest of the day. Paul Tudor Jones ran. Howgard analyzed his losers. Dalio reflected. You must design your own ritual and practice it until it becomes instinct. 6. Journaling framework, daily plus weekly. The journal is not just about entries and exits. It's about emotional data collection. Daily journal prompt. What emotions did I feel before the trade? What emotions did I feel during? Did I follow my stop rules? What did I do when emotions rose? Weekly reflection prompt. Which emotions showed up most often? Did I stop trading when I promised myself I would? What recovery ritual worked best? What rule needs adjustment? This transforms emotion from an enemy into a teacher. 7. The visible reminder system. Your rules mean nothing if they stay hidden in your head. You need them visible when the storm hits. Print your emotional stop-loss rules and tape them to your monitor. Create a sticky note. If I feel desperate, I stop. Or use technology. Set trading platform alerts not just for price levels, but for cool-down breaks. The point is to externalize your rules. When emotion hijacks your thinking, the reminder acts as an anchor. 8. The end-of-day ritual. The way you end your trading day shapes how you begin the next. Close all positions. Don't carry emotional baggage overnight. Write a 3-line summary. What I did right, what I did wrong, what I will adjust. Do something enjoyable outside trading, read, cook, spend time with family. This signals your brain. The day is done. Without closure, you'll stew in frustration, replaying losses and setting yourself up for impulsive trading tomorrow. 9. The weekly emotional audit. Set aside one day, weekend works best, to audit your week. How many times did you hit your emotional stop loss? Did you respect it? What recovery rituals worked? Which failed? Are your emotional triggers changing over time? This is Dalio's pain plus reflection equals progress in action. Every week, you convert raw emotion into structured growth. 10. The long-term commitment. Finally, recognize that building an emotional stop-loss is not an overnight fix. It's training. Just as athletes condition muscles through repetition, traders condition minds through discipline. You won't always get it right. Sometimes you'll ignore your rules, spiral, and regret it. But each mistake is part of the training cycle. The goal is not perfection, it's progress. Over months, these rituals reshape your reflexes. One day, you'll notice, instead of spiraling, you paused. Instead of doubling down, you closed the screen. Instead of revenge trading, you journaled. That's when you'll know your emotional stop loss has become part of you. The final summit. Trading isn't a science of prediction. It's an art of survival. The market is infinite, but your capital and your mind are not. The difference between those who last and those who vanish isn't brilliance, strategy, or luck. It's whether they built the courage to stop themselves before emotion destroyed them. Think back to the mountaineers on Everest. The ones who turned back, who obeyed the turnaround time, were not weaker climbers. They were stronger. They had the humility to descend today so they could climb tomorrow. An emotional stop loss is the trader's turnaround time. It's the discipline of knowing when enough is enough, not because the market said so, but because your humanity demands it. The greats Douglas, Haugard, Dalio didn't win by conquering markets. They won by conquering themselves. They recognized that the storm outside is never as dangerous as the storm within. So here's the final truth. Every account has a monetary stop loss. Every trader must have an emotional stop loss. Without it, you will eventually lose not to the market, but to yourself. With it, you don't just survive, you endure. And in endurance lies mastery. The market will always tempt you with one more trade, one more risk, one more chance at glory. But true strength is not in pressing further. It's in knowing when to stop. That's not weakness. That's wisdom. The next time you sit at your desk and your hands hover over the mouse, ask yourself, do I have an emotional stop loss in place? Do I know my turnaround time? Because the market won't protect you. The charts won't protect you. Only you can protect yourself. And if you can do that, if you can create and honor your emotional stop loss, you won't just save your capital, you'll save the only resource that truly matters, your ability to keep trading tomorrow.